Warren Buffett's investing tip number 6: margin of safety. Definition and importance. Concept. The margin of safety is a principle of investing in which an investor only purchases securities when their market price is significantly below their intrinsic value. This gap between market price and intrinsic value provides a buffer against errors in analysis or unforeseen market downturns. Risk mitigation. By buying securities at a discount to their intrinsic value, investors reduce their risk. The margin of safety acts as a cushion, protecting against potential losses if the investment doesn't perform as expected. Calculating intrinsic value. Fundamental analysis. To determine the intrinsic value of a company, conduct a thorough fundamental analysis. This involves examining financial statements, understanding the business model, evaluating management quality, and assessing the company's competitive position. Discounted cash flow analysis. One common method to calculate intrinsic value is the discounted cash flow analysis. This method involves projecting the company's future cash flows and discounting them back to their present value using an appropriate discount rate. Comparative valuation. Another approach is comparative valuation, where you compare the company's financial metrics, such as price-to-earnings ratio, price-to-book ratio, etc., with those of similar companies in the industry to determine if it is undervalued. Determining the margin of safety. Setting a discount threshold. Warren Buffett typically looks for a margin of safety of at least 20 to 30%. This means he seeks to buy stocks at prices that are at least 20 to 30% below their calculated intrinsic value. Conservative estimates. Use conservative assumptions when estimating future cash flows and growth rates. Overestimating can lead to an inflated intrinsic value, reducing the margin of safety and increasing risk. Applying the margin of safety. Identify undervalued stocks. Look for stocks that are trading at significant discounts to their intrinsic value. Market inefficiencies, temporary issues, or negative market sentiment can create opportunities to buy quality stocks at attractive prices. Avoid overpaying. Resist the temptation to buy stocks at prices close to or above their intrinsic value, even if they seem promising. Overpaying reduces the margin of safety and increases the risk of loss. Patience and discipline. Be patient and wait for the right opportunities. Good investment opportunities that offer a substantial margin of safety might not come frequently, but maintaining discipline ensures that you invest wisely. Historical examples. Coca-Cola investment. Buffett invested in Coca-Cola in the late 1980s when the stock was undervalued due to market concerns about the company's future growth. By purchasing at a discount to its intrinsic value, Buffett ensured a substantial margin of safety, which paid off handsomely as the company's value grew over time. American Express. In the 1960s, American Express faced a major scandal that caused its stock price to plummet. Buffett saw this as an opportunity to buy a great company at a discounted price, providing a significant margin of safety. His investment proved highly successful as the company recovered and thrived. Behavioral aspects. Avoiding emotional decisions. The margin of safety principle helps investors avoid emotional decisions driven by market hype or panic. By focusing on intrinsic value and a safe purchase price, investors can make more rational and informed decisions. Reducing fear and greed. Having a margin of safety reduces the impact of fear and greed on investment decisions. Investors are less likely to sell in a panic during market downturns or buy impulsively during market booms, leading to more stable and consistent investment performance. Challenges and considerations. Estimating intrinsic value. Accurately estimating intrinsic value can be challenging and requires a deep understanding of the company and its industry. Investors must be diligent in their analysis and avoid overly optimistic assumptions. Market efficiency. In highly efficient markets, finding stocks with a substantial margin of safety can be difficult. However, market inefficiencies, temporary issues, and economic cycles can create opportunities for diligent investors. Dynamic business environments. Companies operate in dynamic environments where conditions can change rapidly. Continuous monitoring and reassessment of intrinsic value and margin of safety are necessary to ensure that investments remain sound. Practical application for investors. Research and analysis. Conduct in-depth research and analysis to determine the intrinsic value of potential investments. Use conservative estimates and multiple valuation methods to enhance accuracy. Monitor investments. Regularly monitor your investments to ensure they still offer a margin of safety. Reassess intrinsic value in light of new information, changes in market conditions, or shifts in the company's fundamentals. Stay disciplined. Maintain discipline and stick to your investment criteria. Avoid the temptation to compromise on your margin of safety for the sake of making quick gains. Long-term focus. Focus on long-term value rather than short-term price movements. A substantial margin of safety allows you to hold investments through market volatility, confident in their underlying value. By emphasizing a margin of safety, investors can protect themselves from downside risk and enhance the potential for long-term gains. This principle, central to Warren Buffett's investment philosophy, encourages prudent, informed, and disciplined investing, leading to more stable and successful investment outcomes. Click the link below for more investment tips.